It is March 2025, and what a whirlwind of a year we've already had so far. Now that the tariffs are in place, we've seen $3 trillion in losses in the S&P 5000 this morning, and I'm shooting this on Tuesday, and we are waiting to see how this will impact our market. There are a few things that we know most likely are gonna happen, and who knows? They could be lifted by the time this video is published too, so all of these things that we're gonna talk about kind of can come into play at any time because I don't think this is over yet. Now that Calgary is on the national stage, because of the growth we've seen over the past 4 years, slowdowns in other cities are going to impact Calgary's market. So people like us, you who are watching this, we take it slowly. We look at the information and we make informed decisions that are best for ourselves and for our neighbor. So what do we know about what could happen here? So the first thing that we know is that interest rates are going to drop. So the Bank of Canada is set to have their next interest rate meeting. The next date is March 12th, which is next week. And so we're going to have to aggressively drop these rates more than what we probably would have before. Now, most likely we would have hit a 2.5% bottom from everything that I've read and everything I've looked at. But there's a lot of like BMO and different places are saying that we should actually see that drop to a 1.5% now. If the tariffs didn't come into effect, we effectively could be at some of the lower interest rates ranges that we might have seen, but I think we're going to see them even go even lower. Now, there's even some economists even suggesting the possibility of an emergency intermeeting rate cut of at least 50 basis points. That could happen, it may not happen, but at the end of the day, interest rates are going to drop. Now let's talk about variable rates. A lot of buyers right now, according to a handful of mortgage brokers that we work with, are actually choosing to go with more variable rates than fixed rates. Fixed rates have kind of stagnated a little bit over the last number of months, but as the bond rate has dropped, and I mean, as of this morning, it was under 2.5. And so always you take that 1 to 1.5% range above, and that's what typically the 5-year fixed rate is. So by the end of this week, within the next couple weeks, we could actually start seeing the 5-year interest rate hitting high 3%. Now these levels aren't what we've seen in a long time. It's actually been since March 2022 that we have seen the bond market be this low. So the second thing that we know about is affordability. Over the last year or two, there has been an increase of talk about how Calgary has become a little bit more unaffordable than it has in the past. Now, when you look at it still compared to Canada overall, and specifically Vancouver and Toronto, we are still very, very affordable. Only Edmonton is less. As of Q3 2024, the RBC Affordability Index still showed Calgary as one of the lowest and most affordable big cities in the country. Now, despite Calgary still being one of the most affordable big cities in Canada, when there is a drop in home values and markets slowing down in Vancouver and Toronto, we feel it here too. Inside affordability, I believe there's 3 main parts. There's your borrowing costs, there's your home prices, and then there's income levels. And so all of these 3 things kind of intertwine to create affordability. Now, as I'll share in the data here shortly, we could see some negative numbers in the coming months for the benchmark growth here in Calgary. However, predicting long-term growth and values, that's really, really hard to predict. A Canadian housing market downturn could create buying opportunities for those with stable finances and long-term perspective. Now, if we in Calgary are going to go into the next years and actually just had flat growth, which is not growth, but I think that would actually be a really great place to be. We could see some downward numbers, but we could see some upwards. But if overall we were in a flat market, I think that would be really great. And what that would do would allow incomes to catch up, future home buyers to save up more down payment, and create some stability in our market. Now, the last thing we know about is new homes versus resale homes. In our last month's market video, we talked about how we could potentially see 10 to 15% increases in cost of new homes because of construction materials. Now, if these tariffs are long lasting, we could see that go up, which in turn could push up the resale market values too. Now, over the past couple of years, we have had more speculative investors buying new homes sight unseen more than ever that I've ever witnessed in our city. And in turn, that could actually put downward pressures in our markets. Well, what does that mean? If we've got slower population growth coming from other cities, which could happen, and we also have slower international population growth, which could happen, and we have an increase of basically vacant and, unlived in properties that are newer or older resale homes too, that all of these factors combine kind of snowball effect into kind of a potentially negative situation for our city. But take a look at these numbers. So as of this morning, there were actually many vacant new homes on the market. So much so that 18% of the active listings this morning are new and never lived in properties. And you can see that here on the chart. And so where you see this the most is kind of in the south. There's a few up north, but really this is your main area where there's a lot of these places, as well as downtown. Now this could be a lot of condos, vacant new condos sitting downtown, but really what surprises me is this one down here is all the new homes down in like Mahogany and Seton and those kind of areas that are just kind of sitting there, and they're for sale and they're empty. Now, if we just look at the whole market of Calgary, what properties are vacant? Well, 34% of all the homes on the market right now are just vacant. Now, this is not including the new never lived in properties. These are just vacant ones. And similar, you can see a lot down in the south. It's pretty well spread out to the different areas with a big focus right in the middle there at 390 properties kind of in the city center. And if you're wondering, 35% of the active properties right now in Calgary are owner occupied and only 12% are tenant occupied. So what is happening in the market? Well, let's start looking at the data. Now in our first chart, we're going to talk about a handful of things. The first one is our benchmark price. And our benchmark price as of last month was $587,600, which is up about 0.5% year over year and roughly about 0.7% month over month. So from January to February. And our current inventory, which you can see in the blue lines, is sitting at 4,145. Now this is up 76% year over year, which is a pretty big jump. And the last time we saw this high of a number this early in the year was actually in 2021 in February. Now we have a very different market than we had back then to now, but that's the last time we saw this number or this increase or this high of inventory early on in the year. Now the sales is the red lines down here. Now we had 1,721 sales last month, which is down about 19% year over year. So when we look at prices around the city, you can see that there are some areas that have actually started to see decreases year over year. So the city center has seen a 1% decrease year over year. North saw a 0.3% decrease, where everything else saw increases. As high as in the south was 3.2%, east 2.5%, and then everything else kind of below that. And here's the reality. Last year, at this time right here, we did see some pretty big pushes in values of pricing. So it's not gonna be surprising to me if, as we move forward this year, if we kind of stay in this range for benchmark pricing, that we're gonna start seeing some decreases year over year, which is okay. What I'm personally watching is the number of inventory and the number of sales. Pricing is kind of like, I don't know, it's kind of a lagging thing. Like it shows up after what happens with the inventory, supply and demand, the inventory, the sales, right? And so we'll come back to that because I want to share something that I have some thoughts around it. But when we look at price comparisons all across the area around Calgary, we can see Airdrie was up 3.2%, Cochrane was up 3.7%, Chestermere up, I think it's 0.5%, Strathmore up 5.5%. Calgary was a 5% increase year over year. I think these are all detached properties, yeah. Values. High River saw a 2%, Okotoks was 1.3%, and Canmore saw a whopping 6.2%, sitting at $1.6 million for their detached properties. So when we look at Calgary specifically, again, the market is really shifting right now. Things are really changing. A lot of sellers are almost mourning the market that we used to have. and buyers are coming to the table and they're able to negotiate. They're able to have conditions. The market is shifting a little bit. The sellers aren't getting their multiple offers or higher prices that they think that they should get because it was something before. We're in a shifting market. And now with tariffs in place, uncertainty, as Calgary is tied to the other cities across the country, we kind of can feel a little bit of their movements because people aren't coming here as much. Now, I know there are some of you, there are actually many of you who want to move to Calgary and have chosen either to move to Edmonton or you just haven't moved at all yet. And so we have guides for those. If you want to go look in our content library, we have some guides that you can go and look and figure out exactly where you should live in Calgary, where you should live in Edmonton. But for those that are still waiting, it's probably comment on this because I want to hear it. And as you're commenting, you'll see the subscribe button. Feel free to click that because that's helpful. But when you go to the comments, I want to hear from you. What is your scenario? If you're planning on moving to Calgary at some point, what's holding you back? Because I have a guess that it's because the markets have softened there and you're not able to bring as much equity to Calgary and Calgary's values have gone up. And so with all of these tariff changes, we could see some of this shifting a little bit and people could move here, but it all really depends on how much we're going to see values dropping or the market slowing in other areas of Canada, right? So when we look at number of new listings last month, it was down a little bit from January. So we had 2,830 new listings. Now, when you look at this, we're still kind of in the higher mix of all the past years, right? And that's okay. I'm not too concerned about that. What I have been hearing from our team when they're actively working with people and they're showing people, they are noticing that the properties that are priced well and are really good, like they show well, good condition, they are moving really quickly. And speed is still of the essence, depending on the price range. And the inventory itself, there's just sometimes not a lot of great product to look at. So speaking of which, here's the sales. So sales were up from last month, and sales are up from last month, which they should be, but we're sitting at 1721 for the number of sales last month. And then when you tie in inventory, this number is kind of where I want to focus a little bit on right now. We had 4,145 for inventory at the end of February. And as you can see, this is still not nearly the high that we have seen in the past years. That, I believe, is 2019 from the color, and then you got green, which is probably 2016. So those are the two high years that we've seen, and those were sitting, I mean, 6,000 we roughly around there. So they were sitting at like 58, probably 59, 5,600 listings at that time, back in 2016 and 2019. A lot of people believe, not a lot, there are definitely some, then they're loud in the comments and they believe that Calgary's gonna crash and burn. I don't know if I fully agree with that. And here's where I wanna jump into this. You have to look at population growth. So back in 2016, so when we were in that green number, Calgary was sitting around 1.2 million people. And at that time, and if you look at the green line, it follows right through here, comes down here, and then it drops. So it was sitting in this range. Yeah, pretty much in that range. So like 5,500 to maybe 6. Like it might have pushed over 6, but it was really in that 5,000 range. So 5,000 listings in 2016 was technically a balanced market. In 2021, we were up to about 1.3 million people. And now in 2025, the rough numbers are about 1.6 million people. So we've grown a lot. There's a lot of new people and not a lot of new cars, a lot of different drivers on the road, a lot of things that have changed in our city, and a lot of it is good. However, what is the new range? Because it was very easy back then to say, okay, we got like 5,500 listings on the market, not a big deal. This is gonna be fine. We're in a balanced market, it's pretty straightforward. And that's kind of the general thought. But everything's shifted, a lot of things have shifted. And so what is that new number? And this is very basic math. If there's a better way to do this, let's talk about it in the comments. But 5,000 listings was a basic number for a balanced market, I should say, for 1.2 million people. If we've got about 1.6 million people, that equates to approximately 6,500 listings. So if we look at this number here, so if this number was to increase for whatever reason and came into this range and did that, I think we'd actually still be in a balanced market for this city. I really do. Now, if I erase that, I don't know where it is. There we go. If I erase that, and let's say if our market kind of does this and really shoots up and we're sitting up in this range, well, then that's where we're probably going to flip over to a buyer's market. But I don't think that's going to happen. I personally think what's going to happen is we're going to stay somewhere below 2019 numbers, but for sure we're going to be in that 5,000 range of listings, because I believe that we're going to kind of end up somewhere in here as we go into the spring market. So do not be alarmed when we start seeing benchmark prices year over year numbers dropping, because we had a big push last year. Don't be alarmed when we potentially start seeing 6,000 inventory in our city, because I think that's going to be okay. I really do. Prep had a number, I think it was 26,000 sales they're predicting this year. We could potentially see that decreasing. So for sales per month, if the sales are kind of in this range here, like right in this higher part, but in that area, I think that's probably going to be okay too. At the end of the day, we're going to be okay. I really do believe that. Those that have speculative investments that are sitting on vacant properties, who have pushed themselves to the edge of what they have for, finances, and it's like, ooh, I got an extra 150 grand. I'm just going to go buy another property, or let's leverage that one to this one. Those who are leveraged, there's the right word. Those that are leveraged, they're going to be the ones that are going to be in a tough place. However, not everyone is like that. We're not seeing foreclosure rates jump like crazy. I remember times in like 2014, 15, 2008, 9, when people were looking at the markets and going, all right, I took a foreclosure course from the US and I'm going to go buy all the foreclosures for 50 cents on the dollar. Well, that was never a thing here. I mean, there were for sure deals like that. And I think there were some people who were able to buy properties like that off market with a lot of work. But those types of deals really never came to the market. Not even foreclosures from banks. Like, they were able to get, less than market value, but close to market value still. So Calgary, I believe, is in a position where over this next year, we're going to be in a good position. It's not going to be fantastic. It's not going to be horrible, but we've kind of are in a good situation, I think. So if you want more information, you want more data, there's a lot more in the report that we put out this month. If you're on our newsletter list, you've already got it. It's in your inbox. We send it out to everyone who's a part of our monthly newsletters. But jump in there, get this information, and you should go to the content library and grab it. But let's talk about months of inventory. So months of inventory for the city, as of this last month, is right in there. Oh, I still got the black. So that's right in there. And we were sitting at 2.47 months. Now, a year ago, we were sitting at 1.1. which is way down here. So you can see we are definitely in a different market. We do not have this strong seller's market like we saw last year at this time when we saw prices going up, which was the reason we're probably going to see negative year over year growth in the benchmark prices, which is fine. We're all good. We're all good. And here, so if you remember, 2.5 is kind of the flip number when it goes into a balanced market. So technically we are still, if we're under at 2.47, we're kind of technically under that 2.5 number. So technically the whole city is sitting in a seller's market still, but it's not totally true. So let's take a look at the zones. So if you look at the zones, I've got two numbers on here. I've got a 30-day and I've got a 90-day number. The 30-day number is only looking at sales over the last 30 days compared to what is active. And the 90-day number is looking over the last 90 days divided by per month. So how many sales per month compared to active number today.
What? Bro, what are you talking about, man?
The 90-day number gives us a little bit more of a stable number, but the 30-day can kind of help us predict what is going to happen, okay? So if we've got a 3.5 months of inventory over the last 90 days for a city center, and we have a 3-month of inventory, it's kind of sliding downwards. So basically what that means is it's moving closer to a seller's market, but it's still easily in a balanced market, because again, that 2.5 number, which is right about there, that's the flip over into a balanced market. Now, if you look at east, it is very clearly still in a seller's market. This is north zone, that also is sitting in a seller's market. Northeast, so the northeast zone, they're in a balanced market actually. And you can see they're trending this way. So it's slowing down in terms of if the numbers are going higher. So it's moving closer to a buyer's market than it is a seller's market. Now, northwest, total different story. It's in a seller's market, and the 90 versus 30-day, it's sliding even further. And actually all of these areas are sliding downwards further into a seller's market for south, southeast, and the west. It's a good chart. I like that chart. This is talking about our 90 days months of inventory based out on price ranges. So this is a big chart, lots of information in here, but I'm gonna do a real rough number and kind of show this line is about 4 months, and I'm gonna guess about here is about 2.5, roughly. Actually, that's a little bit low. There we go. Okay, so as you can see, price points that are sitting mainly in a balanced market, you have a handful right here in the 300 to 400 range. So again, that's gonna be a lot of your condos. They're more in a balanced market type area. All of these ones, up to 750,000, they're sitting more in a seller's market. So again, these are going to be your townhomes, some of your semi-detached stuff, starter homes at your smaller 12, 14, 1500 square foot homes, those types of things. When you jump over the 750 range, this is when you start to see some of the months of inventory increase. But as soon as you hit 950, it jumps to 4 months of inventory, and it's kind of up and down, but it increases from there. So you can see that pretty much the whole city under, let's call it roughly 800,000, 750 is kind of sitting in a seller's market. And above 800,000 or 750, 800 and up, it's kind of either in a balanced or moving into a buyer's market. So it really, really depends on where you're buying, the neighborhood you're buying. So months of inventory is one of those pieces of information that's really, really, really helpful when you're looking at a specific property price range in a specific neighborhood to kind of understand what's happening. And then if you want to go deeper, know the 30-day and the 90-day, that's gonna help you a ton. So one thing we were watching last year was the off market. There was big concern that there was a lot of properties on the market that didn't sell, and they took it off the market because they were getting their price, right? And so we saw this spike like crazy at the end of last year, from basically August up until Christmas. And so this Christmas number was nearly 100% of, like, you can see the two numbers here. So there's about 1,300 sales. There was probably over 1,300 off markets in December too. Now, again, I know a lot of listings expire at Christmas or New Year's essentially, but still, that's a lot. So where are we at today with this? Well, we're sitting at 35%. So there was 1,700 sales, like I said, and there was 35% of those were off markets. So we're still a lot higher than we were last year, which was 15%. I think that's, oh, sorry, that's not right. February, we're 17%. So we were a lot higher, and we bottomed out in January, March at 12% last year for off markets compared to sales. Now, you got to remember, this was a time when prices were going up. So we're probably not going to see that low of a number, but I do wonder, like back in 23, we were sitting at a 17% kind of range as we went into the spring market. Now we're sitting at 35. My gut is that we're probably going to level out somewhere in here, but it could still be about 25%, which is a lot higher than we've seen other years. And that goes back to the whole thing I talked about at the beginning, which was the new homes and new vacant properties sitting on the market. People bought these places with 2 years ago prices, and now the market's shifted and we're seeing year-over-year declines, and they're not getting the returns that they were hoping to get. And so now they're basically just kind of trying to figure it out. So if you found this helpful, jump in the description, grab the market update, and we'll see you over here at this video.